Hi, my name is Josh Blanchard, and this is my report on projected interest rates for the week beginning November 8th, 2013 and ending November 15th, 2013. Due to Veterans Day being on Monday, November 11th, 2013, we have to begin graphing our projected interest rates on Friday, November 8th close. The maturity dates on each bond used in the forecast is September 15th up until 2024. When September 15th was not available, the closest maturity was used. Starting on Friday, November 8th, 2013, and ending on Friday, November 15th, 2013, the interest rate forecast showed very little change. The Federal Reserve Bank will keep interest rates low for quite some time, but the question in play is how long. Policymakers have stated that they will keep interest rates down until unemployment falls below 6% and inflation stays around 2%. With the bond markets respectfully closed on Monday due to Veterans Day, we hope for a little action on Tuesday, and that is what we got. 10-year Treasury prices slipped after an auction of $30 billion in 3-year notes on Tuesday. Whenever an abundance of securities are released, price will almost always decrease and rate will increase proportionately. The 10-year bond, which is the most volatile, rose 2 basis points to close out the day at 2.774%, its highest closing yield since September. A stronger number of expected buyers really boosted the 3-month average. The ratio of bids to the amount of debt sold was 3.46 to 1, above the recent average of 3.23 in the past 4 sales, and the highest so-called bid-to-cover ratio since March. The increase in bids is all due to investors speculating on when the Fed will quit buying their $85 billion in securities every month and let interest rates increase, which could leave way for a high profit. Upon analyzing the infamous 10-2 spread, you will notice that the short-term rate rose 1 basis point more than the long-term rate, which continues to flatten out the yield curve. On Wednesday, the Treasury sold $24 billion worth of 10-year securities. The yields decreased due to the influx of money into the system. This is amid Janet Yellen proclaiming that the economy still needs federal aid. Janet Yellen wants to defend the Fed's $85 billion a month bond buying program. She is scheduled to speak on Thursday morning. The program is aimed at lowering long-term interest rates to spur economic growth. Ms. Yellen has highlighted that the Fed has missed its mark to pursue maximum employment and stable prices. She feels that the economy is not at its true potential due to inflation, which is below the central bank's 2% target and will remain below the target for quite some time. When questioned about if she would allow tapering to start, she made it clear that policies are still working and that the time is not right now. Upon analyzing the infamous 2-10 spread, one can notice a 0.05% change from Tuesday's close. The 10-year yield also dropped 16 basis points, closing at 2.609%. This decrease indicates a flattening of the yield curve as well. On Thursday, U.S. bond demand declined as investors favored short-term debt. As the Treasury auctioned off $16 billion of 30-year bonds on Thursday, the long-term securities drew lower than average demand. It seems as if investors are more set on buying short-term bonds in the 3 to 10-year range. So what does this mean? The Federal Reserve will keep moving forward with its bond buying stimulus. Upon Chairman Janet Yellen telling Congress she would promote the bond buying program until economic growth increased, the spread between the 5 and 10-year Treasury bonds had the highest percentage difference in more than 2 years, 1.37% to be exact. With the 2-10 spread up 0.04%, closing at 2.39%, this only strengthens out the argument that the yield curve is flattening. On Friday, November 15th, 10-year Treasury bonds closed out at 2.71%, which has jumped 1% this year alone. The reason for this is because investors are wagering on when the Fed will curtail its $85 billion bond buying stimulus. Another key factor on Friday is the weekly decline of the dollar, which has amid a decline in industrial production and regional manufacturing. This is a sharp signal that the Fed will not stop its bond buying program anytime soon. Since Thursday's meeting, speculators believe Janet Yellen has slammed the door shut on December's taper. Notice on the graph of the weekly change, the way the graph is situated. One can clearly see the flattening of the yield curve throughout the week. Also note that the 210 spread has declined 0.03 to end the week at 2.403%. The 2-year Treasury had a weekly decline of 8 basis points, closing out the week at 0.302. The 10-year Treasury had a decline of 2 basis points, closing out the week at 2.705%. Notice the decrease in the forecasted interest rate throughout the week. It is significant around year 2024. There's a 10% decrease in the forecasted interest rate. The rate falls by 37 basis points from 3.42% to 3.06%. And that's all, folks.